Ever wondered how a well-optimized portfolio can supercharge your investments? In today's video, we're diving deep into our latest portfolio transformation that did just that. Watch the step-by-step optimizing project to multiply by 8 times a $750,000 portfolio in 10 to 15 years. In the graph below, you can see the current assets in the client's portfolio. Our alpha hedge strategy algorithm observed 3 information and defined the portfolio optimization accordingly. Alpha 1, market cycle phase. With this analysis, we define in what time of the cycle the asset is now. We analyze the present situation of the asset. Alpha 2, highest historical positive volatility or highest probability of long-term uptrends. With this information, we analyze the past of the asset. And Alpha 3, highest expectancy ratio. With this data, we analyze what to expect in the future based on statistics, not astrology or opinions. This graph represents the assets that will remain in the portfolio after the optimization process. Post-analysis assets in a negative cycle with low positive volatility and negative expectancy ratio are eliminated, leaving only NVIDIA and American Eagle in the portfolio. The next step is to fill the empty space strategically. This marks only the initial step of the optimization process. Next, we will incorporate the alpha hedge assets to enhance and safeguard the client's portfolio. In the alpha hedge portfolio, we strategically combine leveraged assets with protective assets, adjusting them according to market cycles. This approach has enabled us to consistently outperform the S&P 500 index over a decade. The optimized position size was created by the computer scientist John Kelly in a 1956 paper referenced in William Poundstone's book Fortune's Formula, and later popularized by Edward Thorpe when he applied the theory to beat the game of blackjack. It was also applied by Jim Simmons, founder of the hedge funds Medallion and Renaissance. The formula is based on the principle of maximizing the expected logarithm of wealth, which is equivalent to maximizing the expected geometric growth rate. The formula provides a strategy for bet sizing that leads to the highest possible growth rate in the long run. After integrating the left assets with the current alpha hedge portfolio and calculating the optimized position size to protect and expand this client's portfolio, the graph below represents the November 2023 portfolio. Starting with a $750,000 investment in January 2013, by October 2023, the portfolio's value would have escalated to $6 million, multiplying by 8 the initial investment, just reinvesting the profits and dividends and net of our subscription fees. In contrast, following the traditional 60-40 portfolio would have resulted in a portfolio value of $1.5 million. According to our statistical data analysis, equivalent performance is expected in the next 10 to 15 years. Our clients can monitor the alpha hedge positions in real time, ensuring confidence in the results we present. By the end of this video, you will know how we can work together. Our clients receive individual guidance about what to do with their portfolio's positions, knowing exactly what positions buy, sell, increase, or reduce. We didn't reinvent the wheel, just portfolio management. Traditional portfolio construction, as you know, is outdated. Portfolio optimization tailored for you just arrived. Subscribe to a plan and get access to our optimization strategy applied to your portfolio. Access our website by clicking the link in this video and see if Zurique Capital's portfolio management solution is right for you. I know it totally is. If you have any question, book a call with me and get a guided tour through our subscription and find out how you can change the way you invest forever. I'm Dan Castro, founder of Zurique Capital and author of the Wall Street Insider Report. If you like this analysis, please let me know by liking, commenting, saving, or sharing with your friends. Thank you for watching.